Cool. Welcome, everybody. Thanks for coming again for a very exciting Investors Inner Circle community meeting. Everybody's doing okay? Some people were absent for the longest time and are back. You know, it's like a drug. You can't let go too long. So we have a very, very exciting evening. There was the strike, or maybe still in the high school union. I saw them across from my office on Treasury Street walking with the big signs, right? So I thought, what can we do? I said, what are we saying? What do we want? Right? They want, and somebody else says money, vacation, whatever. So what are we doing? Sharing. What are you doing for? Buy real estate. Continue. I don't know. Make up something. There's no thought process here. Just, my ADD kicked in, and then that's it. But here, we're here to share, to teach as much as we can, and to learn. All those meetings really provide a lot of value to us, Michael and myself, because people are coming, sharing their ideas, what they're doing, how they're doing, what they did that they're doing that worked for them, and what didn't work that well. So, investing in real estate is really an interesting thing. It's not like flat. Sometimes you do amazingly. Sometimes the market changes and you don't know what to do. So by coming here every 3 months, sharing stories, I think everybody becomes a little bit better investor. So our agenda for tonight is very exciting. Not my presentation. It's going to be short, to the point. Usually I talk about market statistics, et cetera, et cetera. So I'm going to talk a little bit about that. I'm going to talk about investment strategies because, again, part of meeting new investors and also existing investors, what should I do now, what to buy, where, what kind of returns I should be looking for. So I'm going to cover 4 strategies and kind of talk about industry standard return. So if you're an investor, somebody approaching you with a deal, what do you think is a fair return for that? So we need to know before we make a decision. The next presentation is going to be very exciting about Michael going to teach us what the high achievers are doing that helping them be high achiever. And things he learned, he's an avid learner. He takes a lot of courses and networks and workshops. And I'm always excited to hear what he has to say. The last presentation of the evening is going to be phenomenal. It's a guy that many people here came through Rich Dad Education, how to invest in real estate. And the statistics, they never share the statistics. But I think the majority of people don't do much, spend a lot of money in learning, and are still too afraid to do anything. So these guys started doing and then started learning. Okay? So while having a full-time job, being able to buy a lot, renovate a lot, and just, unstoppable. He's a Hall of Famer in Rich Dad Education. It's very difficult to get in. So he's going to teach us what worked for him, what didn't work for him, what was his strategy, what is strategy now, and where he sees himself in 5 years. I'm very excited to hear him speak. And by the way, I think it's his first time speaking in front of people. So Kyle, if you're not here, and I know that you are, all of you guys, when he finishes, you jump and cheer like crazy, okay? Like your team won the Super Bowl. Agreed? Cool. One before last part of the evening, we're doing the marketplace piece where everybody can come up. I already spoke to a few people that have different businesses, different ideas, all to do with real estate. You have deals, you have the guy with the $20 million, come say, hey, I have a guy with 20 million. You have deals, you have skills, okay? You have a company that can provide value to other real estate investors. That's your place to share it. Very important, when we're done, we finish around 9-ish, I believe, okay? They won't kick us out until 2 a.m. I have to fly in the morning at 8:55 a.m., so I'm good till 6, okay? So you can stay as much as you want. Make sure that you talk to people, network, really see how people can help you, what you can do for them. Cool? Agreed? Okay, let's start. So let's talk about some market statistics. TREB, see, TREB, used to be Toronto Real Estate Board, TREB. Now it's Toronto Regional Real Estate Board. They probably paid $250,000 for somebody to rebrand. They didn't call me. They should have called me. But because they were gathering information all the way from Bowmanville to Hamilton anyway, right? All the way up to Barrie. So it's really a regional play. But basically, it's the same information. Nothing changed, just the name. We spoke about it. There's not much to chat. We know that in the last 2 years, the market was so-so, right? There were a lot of the mortgage rule changes. The Ontario government started getting involved in all kinds of stuff. So people just didn't buy anything. And then they were able to afford less because the mortgage underwriting law changed. So we spoke about it many times that the market was slow. A lot of realtors in the room, right? You guys saw your business decline seriously and you have to make up, what do I do now? A lot of realtors got out of the business because, 6 months, 8 months is one. 2 years is a long time, right? And it stopped. Well, it's back, okay? And you can see the numbers, these are number of sales, right? 15% increase in number of sales. That's phenomenal from last January to this January. You don't see it here because something is wrong with this. These are new listings, okay? Number of new listings are down 17%. Active listings are down 35%. So a third of the inventory out there is no longer available. We all know what it does, right? When you don't have something, you want it more. Now, people could have bought property 6 months ago, but they waited for the government to tell them what to do. Now the government said, we changed the laws, you can go back and buy again. So, let's buy again. So I'm telling you, the price is going to go up. And this is all over. Prices are going to go up. We spoke last January. I showed the number of land acquisition by developers. You guys work with developers. There were very few. There was a drop of 60% in land purchases in 2018 and 2019 by developers. And when a developer buys land, a year to 2 years until the land is ready to build. Sometimes it needs rezoning, sometimes just need site plan. These things take time, working with municipalities. If they bought less land, guess what? This inventory is going to be even lower moving forward a year, 2 years. So I think the tendency of seeing price increases is going to continue. This is the total, the price. The price increased 12% year over year, January to January. Now, mind you, we had a very mild winter, which helped, right? Usually if it's very, very cold, there's fewer sales, but December was on fire, right? December, that's it, it's back. Good, bad, doesn't matter. It was very, very active before, slowed down, and now all the people that are on the fence are back. Now these things, I'm just going to use one more slide. So it's not only Toronto or Toronto regional, it's all over the country. If you see the black is 2020. I wish you could have seen the cities, but trust me, there are cities here, right? Between Montreal and London and Halifax, only St. John, Newfoundland is actually declining number of sales. But these are numbers of 2019, right? The dark gray, and this is 2020. Now, this number, right, is 60% sales to new listing. Over 60%, it's a seller's market. Okay, so this is where we are right now. So if all of you are sellers, hold offers again, right? You're going to see the bidding war. I don't know if it started now. Bidding wars, right? Realtors in the room? Bidding wars are back, right? Like nothing happened. We had 2 years of, now everything is like before. So there's not much to say. Just, if you want something, don't think it's too expensive because, we know just doing those numbers, it's going to be more expensive next year. So let's talk about the investment strategy because this is really the key discussion for the night. The first one is buy, rent, and hold, right? Where the old school was, I buy something when I have money. Even, people didn't use mortgages, right? Back in the 60s, 70s, if people had money, they bought. They didn't have money, they didn't buy. They didn't use mortgages. Now we want to leverage 100% and still make cash flow. Right? How come I don't cash flow? I didn't put any money down. How come I have to carry this thing? But long-term hold, wherever, even after crashes, eventually it will increase itself. But let's talk about the different types and the different returns from each type. You can do it on, most people are doing it on single-family homes, right? A lot of investors here, single-family home. It's easy, it's simple, and people have to live somewhere, families have to live, it's more stable. But you can do it on plaza, you can do it in office building, you can do it on land. The term called land banking, people are buying land, sitting on it for a long period of time until maybe they can do something with it, change the zoning, and create more value. There's 4 ways of making money in this buy, rent, and hold strategy. The first one is cash flow. It's cash on cash return, meaning I have my rents coming in, I have my monthly expenses going out, property taxes, maintenance, insurance, and stuff like that. At the end of the day, I have a net operating income. From that, I have to pay mortgage. Most people use leverage, so you're paying the mortgage. So at the end of the day, if you look at bottom line cash flow, 2 to 5%, most properties are like that. And this is single family home, commercial, that's regular stuff. Now, if somebody bought condos in Toronto, they may be negative cash flow. Okay, many of them are. But the older properties can show 2 to 5% cash on cash return, which represented around 4 to 5 cap rate. The second part is mortgage pay down. And you know what? I sat with a lot of people over the years, and we did the underwriting, the analysis of the properties, and people don't understand how much money they make by their tenants paying down their mortgage, right? Because you don't feel it. It's like, what I don't feel doesn't exist, but no, it does exist. Every month that the tenant is paying down your mortgage, you're making money. So this adds like 2 to 3% return on an annual basis to your investment. That's phenomenal. How much do you get in GIC? Right? Less than that. And then you have to pay taxes. And here you don't feel it, but long term, you make a lot of money. The third part is really the big profits. Natural appreciation, it's like mostly for single family homes or for residential properties. It can be condos, single, townhouses, et cetera, et cetera. It appreciates over time, whether you live in it, you don't live in it, if it's vacant, if it's rented. It doesn't matter what cash flow it brings, the property goes up in value. We just saw that the property is appreciated on average 12% from last year. Now, we are in Toronto here, you know. Oh, how come it's not going to appreciate at least 10% a year? I'm not buying this, right? This was kind of the ongoing feel in the last 10 years because properties were appreciating 8, 10 years. Every investor was genius, right? They just bought something, waited enough in order for it to double and sold it. Well, that's not normal, but I guess it's a new norm now. You saw the appreciation. But for us as long-term investor, wherever you buy at South Toronto, smaller markets that may show maybe better cash flow, 6, 8, 9%, with 3 to 6% appreciation, you make a lot of money, return on investment over time. Let's just take an example of a house that's worth, I don't know, $500,000. 20% down is $80,000, right? Plus closing costs, let's say you put $100,000 down. If it appreciates 5% a year, right? Not 10, 5% a year is $25,000. You put $100,000 and you just made $25,000. So you made 25% appreciation on your down payment just because the market went up 5%. Okay? So don't look for properties that appreciate only in double digits. Okay? 2, 3, 4% over time, you make phenomenal returns. The last part is where we come into play, the experience, a little bit knowledge, is forced appreciation. How do I take it and make it go up in value further? A lot of people buying single-family homes, right? Adding secondary suite, right? We have guys that are doing it in Brampton. You have like 3 lanes or 3 streets are already under your name? Yeah. They have an agreement with the city every time that they buy 50% of the houses on the street, they change the name of the street. Brampton, you know how to do it. Okay, but they have actually a business to help other people do it. So you take a house, add a secondary suite sometime, 2 units, and then you double or triple the income. Many people are doing it illegally, okay? And hallelujah, great cash flow, phenomenal. I always say, do it legally because it really creates value in the building. If you do it illegally, you can't really capitalize it when you sell it because the city can come any day and just say, that's it, end of story. In commercial, it's really renovating apartment buildings. If you renovate, you increase the rent dramatically. Somebody came to me, showed me a deal in Jane and Finch area. I live a bit south of there, Wilson. And the tenants now are paying between $700 and $900. The going rents in the area are $1,800 to $2,100, right? So I said, listen, you have a big bet, but this area, they have guns. So how do you going to get them out, But they have strategies, they have techniques, they're doing it. But there's tremendous value by bringing new tenants at $1,800, $1,900 versus $800, $900 before. When it comes to land development, right? You take a piece of land, you change the zoning. It doesn't have to be land. A lot of guys that bought, I know 11 years ago, the south part, 401, kind of close to you guys, right? Whitby? The new downtown is going south of the 401, right? All the big boys bought there. I know a guy that bought a FedEx depot, right? So good tenants. And the return was 7 cap rate, so it wasn't a bad deal. And with everything that's happening in the area and the new plans that he did on his land, he tripled the value of the purchase, right? So not only get income over those 10 years, but also have a property that he tripled the value. So this is one where experience come into play. And don't be shy to ask for advice, because not one guy knows it all. And I see it now even more, because we're working with some serious big developers here in the US, and I'm going there. And I'm asking my developer partner a question that I thought he'll be like this, and said, I don't know. It's like, hey, Mike, what's the... Okay, Mike knows. Fine. Right? There's answer for everything. So when you see a property, when you don't know what to do, find somebody in your network, build a network of people. On the construction side, go to Victor, ask him, Victor, how much should I be paying to build a house like that? If any planners in the room or architects, Adam is not here, right? But Adam usually comes, he's a planner architect, right? They know, I have a piece of land that I made an offer now. So I gave it to an architect who was a planner as well. I said, they're going to go to the city, look at the rezoning, look at the official plan, and come back with a rendering what we can build there. I would spend on it a lot more time than them, because they do it over all the time. So the first appreciation, how much, there's no value to put to it, right? You can double, you can triple, or you can increase 10, 15%. But even if you buy real estate for just, cash flow, mortgage pay down, right there you close to 8, 10%, simple and easy. And of course, natural appreciation will increase your value a lot over time. So I think people who are holding properties for 5 years will see a ROI, return on investments, of about 15% a year. Let's look at the next thing. Fixer-upper. Buy low, repair or renovate, and sell at a higher price. I used last time sell high, but then it has some different connotation to it, so I changed the word on it. The things that we need to pay attention, really the location of the place. Any new investors in the room? No. Any investor did flips? Right? Kyle. Your first 5, you made the money that you thought you will make? And that's what happened. Not because, they didn't know what they were doing, just because when they're underestimating, they're doing their calculation, they're underestimating, right? They thought, it's my deal. I'm a real estate investor. I'm going to fix this thing. People are going to pay me a premium just because I did it. It's a feeling thing, right? It's like, oh, it's going to be so nice, especially if I did the work there. It's like the workmanship. Nobody sees what the workmanship is, right? So you overestimate the selling price. And usually you underestimate a little bit your expenses. And you don't really know, right? I mean, there's always surprises. I didn't see one budget in one deal that stayed the same. Okay? But from the get-go, if you put 10, 15% variation, it's good. If you put nada, you're going to have 30. And, the experience bring the fixer-upper guy, fixer-upper, to a situation where he knows how to solve problem for less money, right? I remember I had one property, we had a townhouse complex in Toronto, and the fire hydrant suddenly started leaking, and it was in the complex. So learn, if you have fire hydrant in the complex, not on the road, you fix it, not the city. I called the city, said, you fix it. What do I do? So what do you do who do you call? I didn't even know who to call, right? I called many, and people freaked me out. My God, it's dangerous. The property will collapse. There were a bunch of townhouses there. It will penetrate the foundations. I'm going there. One guy told me, I'm in my truck, I'm going there. I said, where are you going? How much? He said, doesn't matter. I said, what do you mean it doesn't matter how much? How much will it be? I got quotes from $20,000 to $35,000. And then I called Isaac. You know Isaac, right? Michael. Told him, Isaac, can you go do me a favor? He's a plumber. Immigrant plumber. So he's going there. He said, oh, Ron, it's an expensive job. I got to bring the backhoe. I got to dig. I got to do this, that. I said, okay, how much? He said, at least $5,000. Okay, so I paid $5,500 for something that I could easily pay $30,000 because I didn't know. Luckily, I had him. So these are the things that beginner investors are really making mistakes on. And the experienced guys, and I think, Kyle, you have it later on, it's like we're looking for problems, right? Because you know how to fix them. So you're not bidding with everybody on the regular stuff. Now, I really like motivated owner, not motivated property. So I can find a property that's good, but the owner needs to sell for whatever reason fast, move out of the country, it's fine. It's the best thing because there's nothing wrong with the property. But if not, at least look for problematic properties that other people don't want to do it. Basement, foundation, stuff like that. People say, oh my God, it's difficult. We were in Atlanta last year and we saw one guy, an engineer, an Irish or Scottish. I couldn't understand the word he said, but it doesn't matter. It's because of me, not because of him. But all his business is to find these shitty, old, falling apart properties, and all he does is gutting them, fixing the basement, and selling to a renovator. That's his model, right? And he makes $20,000 to $50,000 profit per house because nobody else wants to touch this problem. So when you have more experience, you can afford taking more risk, and this is where you make more money. You add a story, right? If you demolish and build new, it's the next level. But you can add a secondary suite. You can add a second floor. You can build in the back. You can underpin and create a higher basement. All those things that come with experience. And properties, especially in the middle of every city that people want to move into the downtown core, live in the area, it's usually too expensive to demolish and build new. So renovate, right? Nicely renovating. First, you save on HST, but second, people are looking for those newer properties. They don't have to buy 100-year-old properties. The returns. Well, because you're working, I would say this is the return on the money that you put in. Because passively you can make also investments, but if you're putting your own money, you make I think 25 to 50% a year. I would say even 40 to 50 on your money if you're taking the risk and you're buying the property. Now, if you're partnering with somebody else and you're doing this project, 25% for each side I think is fair. Okay, so if somebody's coming to you and say, let's buy a shitty property and you'll make 10% a year on your money, know that it's not fair. Maybe you have other options out there. Cool? Okay. Rent to own, lease option. Yeah, I call it cash flow on steroids. You basically, anybody doesn't know what rent to own is? Don't be shy. Okay, some people are going to never raise their hand, right? Okay. I like that. That should be nice to do that. But you're basically buying a house for somebody else now and you're selling it to them 2 to 3 years down the road. That's usually the time frame. The advantage of the strategy is the tenant pays you a significant deposit when they move in. Usually if you're just renting the property, people pay first month, last month rent, you move in. Here, it's like, how much do you have? Until 5 years ago, anybody could have bought a house in Canada with 35% down, right? The bank had a program, 35% down payment, no problem. They don't have it anymore. Either you qualify to a mortgage, or you don't qualify to a mortgage. So you can have a lot of money, and you want 50% mortgage, and you're not going to get it. Now some banks, yes, secondary financing, but then instead of 3 or 4% interest, you're going to go to 6, 7, 8%, so maybe it's not worth it. So there's a lot of people in need, because also properties go up in value, so they don't either have the down payment or the credit now to afford buying a house. So on the way in, I would say if they pay you 3 to 5% from the future of the house when you're going to sell it to them, right? That's a good deposit. So if you're going to sell it to them for $500,000, an option consideration is $15,000 in your pocket right now. Okay, so you reduce your risk a little bit because you got more deposit from the guys. Higher monthly rent. Usually the rent has the monthly rent plus option consideration. Again, most people don't have money in debt to kind of do a saving plan in order to be able to have down payment 2 or 3 years down the road. But you get the money now. Yes, you're going to credit it on closing, but it's your pocket right now. $400 to $1,000 a month every month. That's a lot of money. And the third advantage is selling without paying a commission. All your real estate agents not going to make money on those deals because the buyer's in the house anyway, already, right? So great investment strategies. The target return is about 20 to 25% a year, which again, in regular rentals, remember you make 3-4% cash flow, right? Here you can make 4 to 8% cash flow just because you get more monthly income, and also the down payment is a bit lower. Now the disadvantage of this strategy is that time consuming. Anybody did rent to own here? Right? How long it took you to find a tenant buyer? Hours per, do you have a statistic, hour per tenant buyer?
Nobody will get it. It's fast, yeah.
Right? It's very, I mean, it's a great strategy, but it's time consuming. It's so time consuming, there are companies out there who actually qualify the tenant buyer for you and you buy it for them. Right? You buy a qualified lead, it's $7,500 to $15,000. I've seen anywhere in this. And the deal still makes sense, right? Because you have a potential buyer and you save yourself 2 or 3 months of work. But it's a time guzzler. So you always have to think yourself, what's my time's worth? Doesn't work in all markets. Hey, not all markets appreciate like we think. You know, you put 2, 3, 4% appreciation in some markets, you go St. John Newfoundland, right? So 2, 3, 4, right, the other way. Like, I'm gonna sell you the house for cheaper. For less, 3 years from now, I want to be my tenant, right? And some markets are just too expensive for that. I mean, there's also a certain price. You know, if you do it up to $600,000 that you have to sell the house for somebody in 3 years, it makes sense. If it's higher than that, yes, there are a lot of people with a lot of money, but they are outliers. But you know, most people won't be able to pay you $2,500, $3,500 a month, right, in order to afford buying a house for you for $800,000 down the road. Once you sell, you need to find another property. So it's a great strategy, but you know what happens in 3 years? You made your money, hallelujah, you're happy. Well, the market went up 30% or 10% or 15%, right? So now you have to find another tenant buyer, right? More time, etc., etc. So it's not really repetitive. It's hard to duplicate. And for us investors, all of you would be very happy, and I think we're going to hear it later from God, if you could do the same thing over and over again, right? Your builders, how many houses he has? 2, 3 types?
Different house types.
Well, if it's building subdivision, right? Usually, which one do you want? A, B, or C?
Yeah.
Right? Because I can do it here and there and there and there. I know my game, right? I don't have to say, what kind of house do you want? How do you think? It's not going to work, right?
That's right.
Okay, it's nice maybe to design, but from business standpoint, repetitive, it's not going to work. Another thing is the property may not appraise. See, last 2 years, properties went decreased in value. So what do? You have a deal with somebody to sell the house for $500,000. It's worth only $470,000. It's not in your control, right? So you have to stop and think, and you have an agreement with somebody. They already paid you, so it's a little bit of a stuck thing. The other thing, the last one is property may be worth a lot more. And you think to myself, is that a problem? Yes, it's a problem. The guy is not here today. One of my students, he was a tenant buyer, 5-year deal. Okay, so he paid for 5 years, and then he calls me one day and said, listen, she doesn't want to sell me the house. I said, okay, send me the paperwork. I see the paperwork, it's not signed. I said, it didn't sign. They did a deal, they forgot to sign. Doesn't matter. I told her, listen, make sure she signs. He sends her the paperwork, she signs on it. And then I said, okay. And she still doesn't want to sell. And she wants another $150,000. I'm like, what? I guess she went to her lawyer or a lawyer and told him, listen, this is the deal we're going to close. He said, well, are you crazy? Now the house was in Oshawa in 2013-14. The deal was supposed to close in 2018. What happened to the market there? Double. Right? He was supposed to buy the house for $420,000. The house was worth $650,000. The lawyer told her, are you crazy? Cancel the deal. Right? And because, I don't know what she was on something. She was a doctor, and they're bright people, so sometimes I don't know why she signed the document a week before, because if she hadn't signed it, could have been a problem. Anyway, I helped him. We took a lawyer, we pushed, we did some massaging, a little bit pulling, and they ended up buying the property with immediate equity of $200,000. But I'm telling you, as an investor, even if you make 30% cash on cash return on your investment, if you're leaving $200,000 on the table, you're not sleeping that night or that week. You're very upset. Money partner, equity partner, joint venture with others. Well, this is usually done on larger deals, renovation of apartment building, plaza, land, construction, etc., etc. This is done with more professionally managed companies, people than just a renovator that goes down deal over. It's all good, it's all better, just different. So more skills are coming together, and this will be repetitive because there's a lot of guys out there who do larger deal renovation, purchasing, developments, etc. So you can come in and find a group that you like working with and say, I can see myself doing more and more business with them. And if you're in business of building houses, right, you have deals all the time, right? And is your builder looking for money? See? Somebody has money here? By the way, 10% stays in the house. But they're always looking for people because they have more skills and more deals than money, or they don't want to put all their money, rightly so, because they have to join the next property, right? They have to put working capital forward, right, to do that. So they're always looking for those opportunities. Is it skill? Is it not what it's doing? Oh, yeah. It can be income producing, it can be apartment building, plazas, office building, storage facility, just maybe, or it can be land development. Important part to look for is the experience of the team, the type of the investment, whether it's apartment building that brings some cash flow maybe, or land that doesn't bring anything. On the way in, it's a little bit more risky. So you really have to assess what type of properties. If you're building retirement homes, phenomenal, right? Now is the market, but there's very few buyers out there to buy apartment, right? We were together. We saw in Peterborough, right, or just outside Peterborough, a retirement home that somebody built, and I think it wasn't the right fit because the big boys looking for 120 to 140 units, certain layout, right? If you build more than that, or you build 55 units, there are fewer buyers for something like that. So the exit may not be exactly what you thought it is. And of course, the term of the project. Graybrook is a very known company. I don't know if many of you work with them or invest with them. They do development of large condominiums, and now they have a project in, I think it's Waterloo or Kitchener. I saw 6.25 years, right, of time frame. So it's fine. A lot of things can happen in 6.5 years, but they work on big projects. So what works for you, right? You want 1 to 2 years, or you don't mind waiting 5 years for your money? Target returns. This is between 15% to 25%. All I put it here is like somebody coming to you said, let's do a land development. I'll pay you 12% of your money. It's not fair. You're risking a lot, right? It's raw land that needs to, a lot of things should happen for it to make money. So you should make more money, right? Because you can buy a house and make 10, 12, 15%, right? So the large company pay 15 to 20. I've seen 25. I've seen development. We were lucky a couple of times recently. We paid over 30 on a couple of developments. But 20, 25, I think annual IRR on a 3-year deal is where you should be looking at. Cool? And anybody investing in such deals, by the way? Okay, 2.5 hands. This is like it's a whale shark. So I say swimming with whales, not with a shark, because swimming with a shark has a negative connotation to it. But he swims. He has a big mouth, this one. He opened it. So you can be this fish, the smaller one, a little bit bigger fish. But he moves there, and you just cruise along with him and enjoy the ride. And there's bits of leftover food that you can grab for him, and everything is fine there. Next thing is be the bank, right? One of my first investors told me, I always think like a bank. I told him, how can you make money? I said, how much money they made last year? I said, I get you. It was a very quick conversation, right? I thought they're very prudent. Yeah, they're prudent, but they're making a lot of money. So you can be a lender, right? I mean, again, we already established that everybody's looking for money all the time, right? You can be equity partner, or you can be a mortgagee. Mortgagor. Mortgagee is the borrower. Anybody speaks English here? Which one is which? What? Mortgagee is the lender? Okay, so what he said. Okay? So the nice thing, it has set return and you know when. Usually it's 1 year to 2 years, right? You're going to make 10%, 8%, 12%, 8%, depends what it is. Another thing is you can do it residential, commercial, construction, et cetera, et cetera. Target return, I put between 8 and 15% because this is, if there's a single family home that somebody needs, first mortgage, 50% loan to value, first, why doesn't it go to the bank at 3%, right? And if there's 50% equity, some other people with money will give it at 5%. I bet you, 6% at most. A lot of competition because it's high quality mortgage, right? And from that, you're going on. 15% is really the top of the line for a mortgage. And I'm talking only first and second mortgages. You can put third, fourth, fifth, sixth mortgages. No, I'm talking first to second. This is where you should be. How to assess a mortgage? First is the loan to value, right? We said 50% residential house. You want to be up to at most 90% loan to value, okay? Not more than in second position, okay? But those things, if you don't know, you can call me, you can call your mortgage broker. You probably got it through a mortgage broker. Tell him, you need to think what happens if they can't pay me back, right? What's my process? How easy is to sell this property just to get my money back? The ranking of the mortgage, I said first, second, third, fourth. I've seen one property with 6 mortgages on it, okay? And the people who go into third and fourth and fifth and sixth mortgages are 2 types. Either the novice ones, they have no idea what they're doing and somebody sold them on this investment, right? Or the other side of the thing, which kind of the whale shark or the shark, the loan to own guys. Are you familiar with that? Loan to own? Right? Yes, no? Communicate with me. Yes, no, maybe. Okay, loan to own. And I've seen a couple of guys and say, how come somebody gave you the money until I understood, right? You give them the money, they're going to default at some point, okay? And your entire reason why you're doing it, because you want to take over the property. Instead of doing power sell and sell it on the market, you're doing a foreclosure. You say, no, I'm going to take over the property in lieu of your debt, okay? So I've seen a plaza in Kitchener that was worth $14.5 million, and somebody gave a mortgage of $10.5 million, and the cash flow couldn't support more than $8 million. So they're going to default at some point, okay? So the lender, after I learned who the lender is, Firm Capital, if somebody knows, right? Got themselves a property with $3 million immediate equity. And actually from the $10.5 million, they put $700,000 for interest reserve. They took fees, so they actually wrote a check only for $9 million. So for $9 million, they got a property that was worth over $14 million. This comes back to the repayment plan. What kind of plan we're looking at? How will they pay it back? Many people have second mortgages on single-family homes, right? Hey, somebody needs 1 year money, $50,000, $60,000, $100,000. Okay, what's going to be in 1 year? How will they pay the money back? And it's very important because if in 1 year they hope somebody else will give them the money, it's a lot of hoping, right? Some people are taking more and more money from here to pay this, to pay that, without really thinking how they're going to pay the money. So the exit plan is very, very important. Okay, a few things I want to touch. They're killing me for time here. By the way, hold on a second. Which strategy is the best strategy? We said fixer-upper, buy, fix and sell, buy, rent, and hold, lending your money or becoming an equity partner. Which one's the best? Huh? Who's the first one said depends? Okay. It's true. It's whatever works for you, right? There's no right or wrong. It's whatever right for you. Just understand the marketplace. Okay, let's touch on a few things that I want to talk. We're always looking for niches in the market, et cetera, et cetera. I'm going to show a few big projects, and I want you to do a lot of due diligence on your own and come teach us later on what you think about those things. Tell us. One of the Downsview Park. You know Downsview Park? The property was sold for $825 million, 371 acres, in the middle of the city, right? That's going to be a game changer. It's a huge project. By 2023, Bombardier is out. So, I never preached for pre-construction, but you know what? It's working for a lot of people. I think in this site like this, for sure, because they're not going to build it all at once. It's going to take them 10 to 15 years to do it, and they won't be able to maximize the price on each one. So let's together learn, get information, pay attention on what's happening here. A senior guy from First Gulf that developed a lot of their properties was just nominated the CEO of this company. It's a pension fund, and it's going to be a phenomenal game changer. Another thing is, Google City. It's called Sidewalk, Toronto. Oh, I don't see it here. Where it's here, see? Toronto Labs, all the way down the river. It's those numbers, right? 44,000 direct jobs and 14 billion economic thing. You know, the construction industry hasn't changed in the longest time. Any builders in the room or something? It's like the same. Well, there are a lot of Therian guys here. It's like you're keeping quiet. It hasn't changed in years. They're changing. Google get into this. We got to change the market now. They're going to build 30 stories from wood frame, compressed wood, right? They're going to collapse the time, right? From to build high-rise 3 years. You know, if you can do it in a year and a half, how much money you're saving? So this is going to be phenomenal. I just read the plan about it. It's a phenomenal thing. So it's going to create new industry within the area and everything around it. For sure, it's going to go up in value even more. Let me jump to this one. Yeah. Innisfil. You know Innisfil? Yeah. Okay. Go train going to be in Innisfil. Innisfil boomed a lot, quiet down, but this was just approved last October. Okay, and it's called the Orbit. This is Innisfil now is 37,000 people. This can accommodate 150,000 people. This is really forward thinking for a small city like that. And they want to keep the rural feel, meaning still close to the lake, the skiing and this and that, but with a very urban feel. So it's a city within a city. It's going to be a phenomenal thing. In 2022, the Go Station is going, you look at the design of the partner with an architectural shop in Toronto with amazing design. So even the design of the train station itself is phenomenal. So again, pre-construction, tenants, apartment buildings. We have a site in Innisfil now, so I'm doing the underwriting on building rental. I'm going to see how it looks. A lot of people moving out there. Not everybody wants to buy. So these are the 3 projects. I'm going to jump quickly through other things. Canada is making it easier for the people, larger mortgages. Right? They changed recently the underwriting law, right? You know how much more buying power it gave people?
3%.
3%. So if you can afford 600,000, now you can afford, who's good with numbers? 618,000. Woo! Your life changed, right? It's all in people's head. We're all stupid, right? Before that, they told us, don't buy anything. So we stopped buying. Now we say, go buy. We're buying, right? Nothing happened, but oh my God, now it's easier for you. Woohoo! It's all psychological. They're really hooked to the taxes they make from real estate, right? They haven't made it in 2 years. They have to bring it back. Oil is not doing that great. This is important thing. You see? Mortgage industry, triple in business. This is a non-bank. This is MIX, Mortgage Investment Corporation. 10 years ago, it was just under 10 billion. This is 30 billion. You don't see the numbers, so I have to remember now. $30 billion of MIX, non-bank. These are all the people who cannot qualify for regular banks. Financing, right? They said, we're going to take short-term 1 year, 6% first mortgage, and then 1 year turns to 3 and 4 years, and then see what happens. The next slide. We're going broke. First quarter, 2019, 18% jump in insolvency in Toronto. Because of those, right? They take money. All the collateral is the house, right? Eventually, it ends. So big jump in insolvencies. Now, it's good because there's maybe some opportunities, especially business insolvencies, right? That owns apartment, commercial properties, because the law of power sale are different from residential to commercial. So if you have big pockets, look for commercial large deals that people bought, over leveraged, and now can't pay them. Rental, demand increasing. In our last meeting, in our next meeting, we're going to have a specific presentation about development of apartment building, start to finish. Is that okay? Yeah, from the raw land up to how do you change this design? 1 bedroom, 2 bedroom, how much of each? What kind of rent? How do you check all those things? This is the future. We said a lot of growth, more immigrants coming to the city. People couldn't buy in the last 2 years, right? They had to rent, so more and more pressure. Apartment building, 72,000 were built in the last 5 years. Still, not enough. The vacancy rate is low. Look in Toronto, with all the condos that are 60, 70% owned by investors, still the vacancy rate is 1%. Okay, so if you want to get into long-term gain, it's not quick flip. Think about how strategically maybe partner with others. This is really the way to go in, and it's relatively safe. Yes, you have construction risk, et cetera, but it's people homes, and we know the rent's going to go up. Now, will this continue? You don't see here. Actually, you see, right? This is the rents. See what happened in Halifax, 15% increase year over year, 15. So even in Saskatoon, right, which by the way, prices of real estate decreased in Saskatchewan itself, right? But still the rent went up 8%. So 8 to 15% increase in rents, and the wages are only 3.8%. So there started to be a little bit discrepancy. I think the government will have to come with some kind of a program to entice the developers to put more capital, maybe depreciated capital or something like that. And then otherwise they're going to feel, what happened in Berlin. You can't see it here. But in Berlin, rents doubled in 2 years. Here it went up 15% 1 year, right? Then take them, and then they say, oh my God, because they're very social, the Germans. So they said, no more real estate increase. Can't increase the rent, 5 years. You know what it does to the real estate value? We're talking about just cash flow loss of $5.5 billion. You think developers are going to line up to buy more property in Berlin? They don't know what they're doing. They're doing a quick 5-year fix, right? But then people not going to buy there. Who's going to buy and develop in the next 20 years? Because they say, if they intervene, big money doesn't like government intervention. So I hope it's not going to happen here. I'm done. The last thing is, your I can is more important than your IQ. Now, Robin Sharma bought and sold a Ferrari. Okay, the monk who sold his Ferrari, right? That's his thing. I thought it was very, very interesting thing, and I just wanted to share that little thought with you. So I'm done my 15, 20, 40 minutes. Thank you so much.